Alright, so if you have already decided that you would want to test your knowledge on this matter, that is swap differences arising on cancellation of forward exchange contract, where the bank has covered itself in the forex market, how does the cancellation of a forward exchange contract take place? There will be a chain of contracts. There is a contract between the importer or exporter with the bank, and bank's contract with the other bank in the forex market. So what I have done, I have formulated a question which will give you comprehensive clarity on all these matters, and particularly the typical doubt asked by many students about swap difference and how that swap difference results into a loss which the customer eventually has to bear. So let's do one thing. Let us start reading out the question. And most important thing that I would want to convey to you, when we are reading questions, we should have a tendency to interpret the lines given in the question in a rightful manner, so that solving of the question becomes smooth and easy going. Once you are clear with what has been asked in the question, solving that question is no big deal. So let us move ahead and deal with the question. In fact, I'll just read it out for you first. It says, on 15/10/2024, X Limited, operating in India, purchased an asset from a supplier in the US at 2 months credit. Now, don't rush with reading the question, understand each line. When I read the first line in the question, what I understand is the entity that is given in the case is an entity operating in India, and this is an importer because it is buying an asset from the supplier in the USA. Now, the supplier has offered 2 months credit, and the date of purchase happens to be 15th October 2024. If you add 2 months credit, the expected settlement will happen after 2 months. That will be what? 15th December 2024, and that is what conveyed over here. Invoice value is $4 lakhs, and expected date of settlement will be 15/12/2024. Fine. For hedging its forex exposure, X Limited decided to take a forward cover. Interbank market rates on 15/10/2024, that is on the date of invoice itself. These rates were as below. Spot $1 equals to, they have given bid and ask rate, and 2 month forward rate is also given to you. Now basically, when you have a set of these rates, point is very simple. Which rate is applicable for you? X Limited is going to be an importer. Because X Limited is importer and has to settle the obligation by payment of 4 lakh US dollars, it is obvious that it will have to buy dollars after 2 months. Buying dollars after 2 months. Now, X Limited is going to respond to the rates quoted by the bank. Bank is going to quote rates in a two-way format, that is bid and ask. When X Limited has to buy from the bank, the rate applicable will be the ask rate. That too, don't focus on the spot rate on that date at all. It is having no relevance. You should focus on the 2 month forward rate, and 2 month forward ask rate is given as $1 equals to rupees 86.6520. Now, this is the 2 month forward ask rate, but look at this line. Interbank market rates on 15th October 2024 were given this way. That means the rates that you are reading are the interbank forward rates. Therefore, when you have to arrive at the rate that bank will quote to X Limited, which is an importer and the entity in our given question, you will have to adjust the margins. So we will have to read in the question where there is an information about the margins given, and we will adjust the margins accordingly to arrive at the rate applicable for X Limited. Further, it says on 15/12/2024, X Limited did not show up for settlement. Now, obviously, the contract was entered into on 15th October 2024, and 2 months credit, that is 2 months period of forward, will end on 15/12/2024, which was actually the settlement date. Now, maybe that the importer would have already discussed with the supplier that they might extend the credit or they would want some additional credit whatsoever, but they should have approached the bank on the settlement date, because it was not just the payment date, it was also the settlement date for the forward contract entered 2 months prior. Now this date, when it was the settlement date, X Limited did not show up for settlement. Now basically in real life situations, nobody does like this, okay? When there is a date of settlement, the importer will approach and take the suitable action. But fine, this generally is the pattern of the question, because ICAI wants to test out whether you are aware of what can be the outcome when on the settlement date the customer, who could be importer or exporter, whoever, is not showing up for the settlement anyway. So the fact is X Limited did not show up. On this date, the interbank spot rate was, again interbank spot rates have been given, bid and ask. On 15/12/2024, that is on the same date, the bank had to swap its position through Forex market because bank also has covered itself. Now this is the point where this swap difference originates. Now see, let's not get too much bogged up with too many information. Let us go step by step in understanding the question. I repeat one thing again, that understanding the question is very, very important. So what we are supposed to do, we are clear with one thing, that bank has also covered itself. So now there will be a chain of contracts for sure. See, $4 lakh may not be always, or may not be usually available with the bank, right? If X Limited wants to buy 4 lakh US dollars, that much quantity of cash bank will not carry. It is obvious. So to provide $4 lakh to X Limited, bank itself will have to arrange from other banks in the Forex market. And that is where the bank, which is a bank operating in India, will arrange from a foreign bank the supply of these 4 lakh US dollars, which can be eventually transferred to X Limited. And this doesn't happen in the cash format anyway. There will be always fund transfer from account to account. You know it very well. Now, what is going to happen in case X Limited is not showing up on that settlement date, that is 15th December 2024? Keep in mind one thing, the bank has also covered itself. That means there is a chain of contract. One contract that X Limited has with the bank in India, and other contract that the bank in India has with other foreign bank in the Forex market. Now, we are talking about application of FEDAI rules. FEDAI rules, FEDAI, stands for Foreign Exchange Dealers Association of India. Now these rules are designed for the dealers operating in India. These rules are not for foreign banks. Why foreign banks would follow FEDAI rules? That means FEDAI rules are asking the bank operating in India that, see, if your customer did not show up on the settlement date, you cannot automatically outright cancel the contract. You have to wait for 3 working days. That is the rule. You have to wait for 3 working days, and customer may come up within these 3 days and ask for settlement of the contract, ask for cancellation of contract, or maybe asking for extension of the contract. Whatever be the customer's request, you need to consider that request. However, to arrange this whole matter, in case you suffer with any loss, you can recover that loss from the customer. That protection is given by FEDAI rules to the dealers in India. But dealers have to take some action. They cannot leave it just like that anyway. So the point is, we have a chain of contracts. Contract of X Limited with the bank operating in India, which cannot be automatically cancelled even if the customer, that is X Limited, did not show up on the date of settlement. However, what happens to the other contract that the bank operating in India, which has taken a forward cover through the Forex market from another bank to arrange those 4 lakh US dollars at 15th December 2024? That contract cannot stay hold. That contract eventually will get cancelled out, because definitely on that date, on that settlement date, 15th December 2024, this bank operating in India is not going to take the delivery of 4 lakh US dollar because it is uncertain about what X Limited is going to do. In other words, it is uncertain about what its customer is going to do. So what we are supposed to do now, there will be definitely implication of cancellation of the contract that the bank in India has made with a foreign bank in the forex market. Now, what we are supposed to do now, that one set of contract will get cancelled out, another contract stays alive because of the FEDAI rules. Anyway, let us read the question further. So, understand one thing, a contract that came to a dead end, the date of settlement was 15th December 2024, and on that date this party X Limited did not show up for settlement. So actually speaking, logically the contract stands for automatic cancellation, logically, but the FEDAI rules coming into picture, they are asking the bank in India or the dealers in India to wait for 3 working days. That means a kind of dead contract is meant to keep alive. Correct? A dead contract is the term I am using. Okay, a dead contract is meant to be kept alive. You will have to bear some cost for keeping that contract alive for 3 more days, and that cost comes in the form of swap loss. So when I am explaining you what exactly is swap loss and how it is determined, keep in mind one thing very clearly, that it is basically a cost that the customer will have to bear for making a dead contract kept alive for 3 more days because of application of FEDAI rules. So logically how to compute it and how to execute the whole matter, we are going to discuss in as much detail as possible, but let us first complete the question reading. So it says, for this purpose banks sell spot $4 lakh and buy 1 month forward at rupees 86.6960 per dollar. Now what bank is doing to swap its position, I am going to discuss once again in detail when we reach that point of calculation. The margin applied by bank over interbank rates was 0.12%. Honestly speaking, the moment I read this point in the question that these rates were interbank rates, I was waiting for that particular information in the question, that where the question informs this particular matter, that is the margin to be applied by bank, and now here it is revealed that it is 0.12%, and because the applicable rate over here was the 2 month forward ask rate, to ask rates we always add margin. So all these concepts I have explained earlier, that why we should add margin to ask rate and why we should subtract the margin from the bid rate. You have learnt it already. In case you haven't learned all these matters, then I would advise, instead of taking up test questions like this, you better first go and refine all your basic concepts, and then you can come back to attempting this test. And interest charged by bank was 18% per annum. Now generally when there is a kind of delay made by the customer, there may be some outlay of funds by the bank, and bank will not have outlay of funds without charging interest. For that purpose they have given the interest rate to be charged by bank as 18% per annum. So for your reference, what I'll do is I'll just place the question on screen, and you can take the screenshot if you want, or you can pause the video and note down the question. If you don't want to do all that, I have anyway given the question in the description box. The PDF of that question will be there. You can just download the PDF and use it for your reference. But anyway, I'll just display this question part to you for a moment. Alright friends, once you have taken note of this, let us move ahead and read the later part of the question. On 17/12/2024, that is basically after 2 days, X Limited approached the bank and requested for extension. The revised settlement date shall be 15/2/2025, that is 15th February 2025. On 17/12/2024, that is the date on which X Limited has approached the bank, following rates were observed in the forex market. The moment they say forex market, these will be definitely again the interbank rates. So don't forget to adjust margins wherever required. So spot rate was given in the bid and ask format. 2 month forward rate is also given. Why 2-month forward rate is given applicable over here? Because the extension is happening by 2 months. Instead of 15 December 2024, the new settlement date will be 15th February 2025. The bank quotes the exchange rates to its customers in 2 places after decimal. You are required to determine the following. Number 1, contracted forward rate for X Limited on 15/12/2024. That is on the original date of entry into the contract. What will be the applicable rate for X Limited to book the original forward contract, which we can call as the contracted forward rate. Now, because the contract is going to be cancelled, of course, you know one thing, that for extension you have to cancel the old contract and execute a new contract. So for cancellation, the approach by X Limited was on 17/12/2024. So they are asking cancellation rate applicable to X Limited on 17/12/2024. Over here, I would like to highlight one important point. I told you there will be a chain of contracts. Contract between X Limited and the bank operating in India, and the other contract, that is the contract between the bank operating in India with other bank in the Forex market. Now, the contract between the bank operating in India and the other bank in the Forex market will cancel out on 15th December 2024 itself. On the other side, the contract between X Limited and the bank that is operating in India, that contract will get cancelled out on 17th December 2024. So let me just read out the remainder part of the question for your reference. Third thing that they are asking is the cancellation charges payable by X Limited to bank. Number 4, outlay of funds by bank on 15/12/2024 and interest thereon. Number 5, amount of swap loss if any. Number 6, total charges payable by X Limited on cancellation of forward contract. And number 7, new forward contract rate applicable for extended period. Now guys, please understand one thing. You can take the screenshot if you want. Just pause the video and note it down if you want. So now if we have to proceed with the solution, what I'll do is I'll just take you first to the flow of how we need to approach the question for formulating the solution, and then I'll present the solution over here on screen. One thing, let me be very clear, I'll not give you separately any time to note down the solution. I'll just display the solution portions on the screen. Whatever you have to note down, you can pause the video and note it down, and then you can move ahead. So let us do one thing. Focus on what is the first requirement in the question. Question is first asking you, number 1, contracted forward rate for X Limited on 15/10/2024. So 15/10/2024, that was the date of the invoice. On that same date, the company, that is importer company X Limited, has approached the bank for taking the forward cover. So basically it has a need to buy 4 lakh US dollars, correct? The invoice value is 4 lakh US dollars, and it has to buy 2-month forward. So on 15th October 2024, these were the rates, and as we have already discussed, what you are going to do is you are going to consider 2-month forward ask rate, that is 86.6520, and these rates which are given on 15th October 2024 are basically the interbank market rates, and therefore you have to add the bank's margin on the 2-month forward ask rate. So focus on 86.6520, which is 2-month interbank forward ask rate, and we need to add a margin of 0.12%. So let's pick the calculator. I take the interbank forward rate, that will be the ask rate, 86.6520. To that we add 0.12%, which comes to 0.1040, and when we add it, it comes to 86.7560, and we need to round it off to just 2 places after decimal. So it will be what? 86.76. So 86.76, that is $1 will be equivalent to 86.76 for X Limited to have a commitment towards the original forward contract. That means the obligation which will be defined for X Limited will be based on the rate of rupees 86.76 per dollar, and the contract size will be 4 lakh US dollars. That will be the answer for the first part. So let me again read that thing. Yeah, contracted forward rate for X Limited on 15/10/2024. We have worked out that. Now in a while I'll be presenting that solution to you. Second thing, what is being asked, cancellation rate applicable to X Limited on 17/12/2024. Now obviously original date of entry in the contract was 15th October 2024. It was a contract for 2 months forward. That means the settlement date was supposed to be 15th December 2024. Because X Limited did not show up on that particular date of settlement, and it has approached the bank after 2 days delay, that is on 17th December 2024, the cancellation of contract between X Limited and the bank operating in India will happen on 17th December 2024, and we are supposed to find the cancellation rate. So simple logic is, the original forward contract was to buy dollars. To cancel that contract, you have to sell dollars, and sell dollars at the spot rate prevailing on 17th December 2024. Look at these rates. These are the interbank market rates given for 17th December 2024. And we are not concerned with the 2-month forward rate right now. We are concerned with the spot bid rate on that date. Look at the spot bid rate on that date. It is 86.4950. Now this is interbank spot bid rate. So because it is interbank spot bid rate, obviously what you will do, you will be taking the interbank spot bid rate, and from that you will subtract the margin to arrive at the cancellation rate that will be applicable for X Limited. That will be on 17th December 2024. And let me work it out for you. I'll take the spot bid rate on 17th December, that is 86.4950. On that I apply 0.12% margin, that comes to 0.1038, and when I subtract it, what I get is 86.3912, which can be rounded off to 86.39. So 86.39 will become the cancellation rate applicable for X Limited. That will be on 17 December 2024. Let us move on to the next requirement in the question. The next requirement, cancellation charges payable by X Limited to bank. Now, you have worked out in the initial 2 workings, what 2 things do you remember? Original contracted forward rate to buy dollars from the viewpoint of X Limited, and the cancellation rate applicable to X Limited. Both of these rates you have computed in the first 2 requirements. So basically you have determined both rates, that is the rate at which X Limited agreed to buy and rate at which X Limited agreed to sell 4 lakh US dollars. Find the difference between these 2 rates and multiply that difference to 4 lakh dollars. That difference will be the cancellation cost for X Limited. Of course, other charges kept apart, purely the cancellation charges will be based on the difference between those 2 rates multiplied to 4 lakh US dollars, which can easily be worked out. So I'll show you the calculation when we reach this particular point. And let me do one thing. Let me first work out these 3 things for you in terms of presenting the solution, and then I can take you ahead with the later part of question and solution, so that we can keep having control over the entire solution presented. So on 15/10/2024, for buying $4 lakh at 2 months forward, the applicable ask rate for X Limited shall be, you can first consider the interbank 2-month forward ask rate, which is given as rupees 86.6520. To that you add 0.12% margin, and that comes to 0.1040. Adding the margin, you get the applicable ask rate as rupees 86.7560, which can be rounded off to 2 places after decimal. That will be rupees 86.76. This will be the answer for the first part of the question. that is the applicable rate for X Limited to buy $4 lakh at 2 month forward. This is the original contracted forward rate. Now on 17th December 2024, for cancellation of original contract, X Limited must sell spot $4 lakhs. Applicable cancellation rate for X Limited will be, now you can find what is the spot bid rate on that date, that is 17th December. It was rupees 86.4950 per dollar. Because it is the interbank spot bid rate, from this rate you are supposed to subtract the margin, and subtracting the margin at 0.12%, that margin works out to rupees 0.1038 per dollar. When you subtract that margin, what you get is rupees 86.3912 per dollar, which can be rounded off to rupees 86.39. As I told you earlier, I am not going to separately give you any time to note down the solution. You can pause the video and take note of all these workings, and then we move ahead. Alright friends, once you have worked out these two calculations, now the third requirement in the question is a connecting requirement. Look at this. 86.76 per dollar is the rate at which X Limited has agreed to buy $4 lakh. 86.39 per dollar is the rate at which it had to sell $4 lakh to cancel its original forward contract. So if you want to compute cancellation charges, simply rate at which X Limited agreed to buy, it was 86.76. Rate at which it had to sell for cancellation, it was 86.39. So you are buying at an expensive rate of 86.76 and selling at a little lower rate of 86.39. Obviously you will be incurring a loss. 86.76 minus 86.39, that loss would work out to 0.37 per dollar. This will be multiplied to $4 lakh, and that works out to rupees 1,48,000. So 1,48,000 will be the cancellation charges payable by X Limited to bank on 17th December 2024. That will be the answer for the third requirement in the question. Let me just quickly show it to you over here. So as I have told you, you are going to take the difference between those two rates. So X Limited buys at 86.76 and sells at 86.39. So loss per dollar works out to rupees 0.37, and total cancellation charges will be $4 lakh multiplied to rupees 0.37 per dollar. That will be in total rupees 1,48,000. So after all these calculations have been worked out, we need to look into what was the requirement in the question for the fourth part. And fourth and fifth part of the question, it is very, very important. Sixth and seventh part of the question again is very simple. When we read, we knew that it is nothing major. So when students are approaching this type of question, they generally get stuck up in two important calculations. One is the interest on outlay of funds, and second thing is the computation of swap loss. Let us discuss both of these in detail, but let me first take you back to the question. Just allow me to change the slides over here. I'll bring back the question slide once again. Look at this. This is the scenario at the start of the question. Look at this. If I read this paragraph in the question, it says on 15 December 2024, X Limited did not show up for settlement. On this date, interbank spot rate was $1 equals to 86.4665 and rupees 86.6655. Basically, this is the spot rate, that is interbank spot rate on 15th December 2024. That is the date for settlement of the original contract. Now you please understand one thing. For X Limited, when you computed the cancellation rate, because from the viewpoint of X Limited, the cancellation is supposed to happen on 17th December. So we adopted the rate given for 17th December. Let me take you to the next slide in the question. Look at this rate. That is spot bid rate on 17th December was 86.4950. Again, that being an interbank rate, you have to subtract the margin to arrive at the cancellation rate for X Limited, which we have already computed. Right now my concern is to deal with the fourth requirement. Let me now read the fourth requirement. It is asking outlay of funds by bank on 15th December 2024 and interest thereon. So what happens? Why there is an outlay of funds by bank on 15 December? If you can recollect, while explaining you the questions flow, I have mentioned one thing, that there is a chain of contracts. One contract is between X Limited and the bank operating in India, and the other contract is between the bank operating in India and the other bank which is in Forex market, through which the bank operating in India is going to procure 4 lakh US dollars. Now the bank in the Forex market and the bank operating in India, these two banks will have to cancel their contract on 15th December 2024, and for that purpose the rates applicable on 17th December 2024 will be completely irrelevant. That is why we have to focus on the spot rate prevailing on 15th December 2024. Now what will happen? From the viewpoint of the bank operating in India in relation to the Forex market, the agreed rate at which bank in India has agreed to buy 4 lakh US dollars, that was 2-month forward ask rate 86.6520 per dollar. Now this is the interbank rate, and this has to be the interbank rate because the contract is between two banks. That is why let it be interbank rate. Here you should not adjust the margins. So bank operating in India has agreed to buy dollars at what rate? At rupees 86.6520, and it has to sell these dollars for cancellation at the spot bid rate, which has to be interbank rate, but the spot bid rate prevailing on 15th December 2024, and that is this rate 86.4665. So if you can observe 86.6520, I'll pick that 86.6520 minus, because this is the rate at which the bank has agreed to buy from Forex market, 86.6520 minus this rate at which it has to cancel, that is 86.4665. I take the difference between these rates, so minus 86.4665, that difference is coming to 0.1855 per dollar multiplied by 4 lakh dollars. That will be the cancellation charge that the bank has to pay in the Forex market. Now understand one thing very clearly. In earlier concepts and questions we have already discussed one thing, that cancellation charge that the bank is paying in the Forex market for cancelling its own contract, it is no big deal because it is going to recover much bigger value from the customer. But the problem is this cancellation charge will be paid by the bank operating in India on 15th December, and it will recover the cancellation charge from X Limited, that is the customer, on 17th December. Till 2 days from 15 December to 17 December, it is the bank's fund that gets blocked. So bank will recover that money from the customer, that is X Limited, as part of the cancellation charges charged on X Limited. But because of the 2 days of fund blockage, it will also be recovering interest thereon. So let us work out two important workings, that will be the cancellation charges paid by bank in the Forex market, which will be the outlay of funds on behalf of X Limited, and because of the 2 days delay, what is the interest charge thereon. Let us work out these two as well. Now to proceed with the solution, you will write calculation of outlay of funds by bank on 15/12/2024. So bank buys dollars at rupees 86.6520. This is the original contract rate, and the cancellation rate for the bank will be rupees 86.4665. This was the spot bid rate on 15/12/2024, correct? Spot bid rate on 15/12/2024. Both of these are interbank rates and it has to be that way only. So why there is a loss? Because the bank is buying from the forex market at 86.6520 and selling at 86.4665. The difference will be obviously loss per dollar, that is rupee 0.1855. So total outflow on 15 December 2024 will be the loss per dollar multiplied to $4 lakh, and that comes to rupees 74,200. This is the amount that bank will have to pay in the forex market for cancellation of its contract with the overseas bank, whichever bank it has entered into the contract with. Now important thing is, as I told you, please understand this point very well. Bank is going to pay in the forex market 74,200 and bank is going to recover 1,48,000 from X Limited. Now this already takes care of the bank's margin. So bank is having this as a cash inflow and bank will have this as a cash outflow. The net difference is anyway the profit for the bank. So bank has earned already its part. That means 1,48,000 what bank is recovering from X Limited, it includes the compensation of this 74,200. What it does not include is this money bank has to pay on 15 December, whereas this amount it will recover from X Limited on 17 December. That is where there will be outlay of funds for 2 days from bank's pocket, and bank's money got blocked for 2 days. On that bank will recover interest. So before I show you the working for the interest, which is going to be very simple working, you can pause the video and take note of this part of the solution. So once you have completed this whole thing, let us move ahead and look into the calculation of interest on outlay of funds for 2 days of delay. Simply you will take the outflow by bank's pocket, that was 74,200, into 18% into 2/365 for computing 2 days interest, and that works out to 73.18. This was not included in the cancellation charges that the bank is going to recover from X Limited. So this amount bank will be recovering separately from X Limited. Now this amount you can round it off to rupees 73. Quickly take note of this working as well, and then I take you ahead. Now comes the most critical point in the solution, that is calculation of swap loss. Now this is the biggest point of doubt, and let me clarify this point very well. Which date exactly you are computing this swap loss? That you should first be clear that which date this swap loss is getting computed. This swap loss is not getting computed on 17th December 2024. This is computed on 15th December 2024 itself. Now, why there is a swap position that the bank has to take? Second thing, how that swap difference arise, why it can result into a loss, and why bank should recover that loss from X Limited. Let us discuss each of these points in detail. So when we started discussing the whole scenario, we have talked about chain of contracts. Contract number 1, that was between the importer company X Limited and the bank operating in India, and the second contract was the contract between the bank operating in India with the other bank in forex market. So first contract actually got cancelled on 17th December. But this second contract between the two banks, it got cancelled on 15th December 2024 itself. So actually speaking, the bank's position in the forex market got squared off on 15th December 2024. Matter got over. But because of FEDAI rules, the bank operating in India, whose customer X Limited did not show up on 15th December for settlement, bank has to keep that contract with X Limited alive. It cannot cancel that contract because of no show up by X Limited. It cannot cancel. The FEDAI rules is asking our bank in India to wait for 3 working days. In these 3 working days, X Limited can approach the bank and ask for settlement of the contract, or it can ask for cancellation of contract, or it can ask for extension of the contract. Whatever X Limited is willing to do, it is having privilege to delay by 3 days also. No more delays beyond 3 working days is permissible. So let us assume that suppose this importer company X Limited does not show up even in that 3 days grace period, then what? Then the bank operating in India will simply cancel the contract between X Limited and the bank itself. Now what will happen? Here on 15th December, the contract between the bank in India and the bank in Forex market, it got cancelled, but the bank operating in India has to keep the contract with X Limited still alive. Now understand one thing, a contract which was supposed to come to an end on that date, and the connecting contract with the Forex market were already got cancelled. You are trying to make a dead contract stay alive for another 3 days. This you can do only when you don't cancel that contract. But do you know what is going to happen? This importer company X Limited can simply come during these 3 days of grace period and ask the bank in India to honor the contract or to settle the contract. In that case, the bank in India is committed to supply 4 lakh US dollars at the original contracted forward rate. Now, obviously, it will not be in a position to avail the dollars at that rate. Therefore, what happens? To make its position secured, the bank in India has to take some action. It has to secure a rate at which it can buy dollars. Therefore, on 15th December, it undertakes an open forward contract in the Forex market with some other bank. What is the meaning of open forward contract? Open forward contract refers to a contract where date of settlement is not fixed. It means between the two banks, it is understood that in coming 1 month time, whichever date the bank in India wants, it can take the delivery of those 4 lakh US dollars at the agreed rate for that open forward contract. Sorry. So let me first take you back to the question, and over there I'll highlight this particular point. Now look at the question. On 15 December 2024, X Limited did not show up for settlement on this date. Interbank spot rate was $1 equals to rupees 86.4665, and this is the ask rate, which we are not concerned with. On 15 December 2024, the bank had to swap its position through Forex market because bank has also covered itself. For this purpose, bank sell spot $4 lakh and buy 1 month forward at rupees 86.6960 per dollar. Now look at what is happening. This is the point where you have to give your 100% attention. One side, on 15th December, the bank operating in India sold 4 lakh US dollars in the Forex market to cancel its contract in the Forex market. Now that cancellation executed. However, to keep the position still standing for its customer X Limited, whatever bank has sold, it has again agreed to buy for 1 month forward. This 1 month forward is basically meant only for taking care of those 3 grace days. The bank in India cannot secure a contract for 3 days, not even for a period like 1 week. It is not possible. In international Forex market and everywhere, you will find that the minimum period of contract, that is for forward contract, will always be 1 month, and it is in the monthly variation. 1 month contract, 2 months contract, 3 months contract, and the like. Now, what is the immediate date at which the bank has to secure that contract for a maximum period of 3 extra working days? Look at this date, 15 December 2024. From here, if you count 3 days, 16, 17, 18. I'm assuming all 3 days are working days. So 16, 17, 18. 18 December 2024. Only up to that point, the bank has to keep the original contract with X Limited alive. And it has to provide 4 lakh US dollars to X Limited at the original contracted rate in case X Limited wants to settle the contract. Now, from where will this bank in India get that rate? It is impossible, right? So, it is asking the Forex market, that is the bank in Forex market, that please provide us an open forward contract where we can buy 4 lakh US dollars at this rate. That means one side it has sold 4 lakh US dollar for cancellation at this rate, another side it is committing to buy again at this rate. Now this is the rate quoted by Forex market as 1 month forward rate, and this is considered as an open contract where any day this contract can either be honored or cancelled. Now it has agreed to buy at 86.6960 per dollar. Now what happens? Suppose X Limited comes within a couple of days and demands the settlement of the contract. X Limited will be capable of buying 4 lakh US dollar at the original contracted rate which we have worked out at the early part of the solution. It still has the right to buy dollars at that same rate that was initially agreed upon. However, for that the bank will be able to secure dollars only at 89.6960, correct? So bank sold dollars at 86.4665 and will have to buy dollars at 86.6960. See, the gap between the interbank forward rate and the original rate agreed by X Limited, which was bank's margin, bank has already earned that margin. Now bank has to just compensate itself for its loss. Which loss? This is the swap loss. Bank had to sell dollars on 15 December and immediately agreed to buy dollars again at this new rate. This rate is not the rate quoted on 17 December. This is the Forex market rate on 15th December itself, which will be a rate applicable for open forward contract for 1 month. Now that open forward contract for 1 month can be settled anytime by end of December. Over here, within 3 days, 3 days will fall by what? 18 December. 18 December is definitely coming in the month of December. So this 1 month forward, we just say for 1 month. Open forward contracts are always mentioned this way: December forward contract, January forward contract, February forward contract, and so on. So December forward contract is what bank has taken up just for one objective, so that it should be able to provide the required quantity of 4 lakh US dollars to its customer X Limited at the original rate. And this loss, what it is going to suffer over here, it will recover from X Limited. The question is, why this loss the bank in India is going to bear? I mean, even temporarily, why should it commit? Because imagine a scenario that bank in India does nothing to swap its position. Let's take the extreme scenario that the contract of bank in India with the Forex market got terminated on 15 December and our bank in India, it does not take any action at all. Now what can happen? After a couple of days, when X Limited is approaching the bank, X Limited demands that, see, I want the settlement of this contract. I am sorry I got late by 2 days, but I want the settlement. Please go for the settlement of the contract. Now what will happen? If the bank in India has not taken any swap position, it will have to buy dollars at whatever rate it is prevailing in the Forex market. It may procure dollars at a cheaper rate actually and make a settlement. That is a speculative position which can result into a gain for the bank in India, but that speculative position can even result into a loss to the bank. In that case, if without taking any action, if the bank in India is suffering for a loss on this whole transaction, that loss FEDAI rules will not permit the Indian bank to recover from the customer. So if the bank has to fully secure and safeguard itself on behalf of the customer, it has to secure its position by taking a swap position. What is the meaning of swap? See, for cancellation of the original forward contract, X Limited did not show up on 15 December. Bank in India had to cancel the original forward contract with the Forex market. It cancelled the contract at 86.4665, means it agreed to sell 4 lakh US dollars at 86.4665, and at the same moment it is agreeing to buy same quantity of dollar at 86.6960. So if you can work out 86.6960, this is the rate at which it agreed to buy, minus what is the rate? The rate is 86.4665. What is the difference? Difference is 0.2295. Now please understand, this difference of 0.2295 is not cancellation charge. It is an extra burden because you just sold dollars at a lower rate and immediately committing to buy dollars at a higher rate. And for whose mistake? For the mistake of the customer X Limited. Who is going to bear the loss? X Limited will have to bear the loss. Bank in India will not bear this loss. In case this was a gain, then passing that gain to the customer or not passing the gain to the customer could have been bank's decision. But when bank is incurring a loss for this, for safeguarding the position of customer, it has all rights to recover. So in a nutshell, how much will be the swap loss? This difference what I just computed, that is difference between 86.4665, the rate at which it is selling dollars, and 86.6960, rate at which it is committing to buy those dollars again. Difference between these two rates, which is a loss because you are buying or committing to buy dollars at a higher rate, that difference multiplied by 4 lakh dollars. That difference on my calculator shows up 0.2295 multiplied to 4 lakh dollars. It comes to 91,800. This 91,800 is not to be paid by the bank in India in Forex market right away. It has agreed to take that load, not for itself but on behalf of the customer. So on 17th December, when X Limited is approaching, our bank in India will recover from X Limited 3 charges. Number 1, cancellation charge. Number 2, the interest on outlay of fund. Both of these we have already computed, and on top of that it will also recover this rupees 91,800 towards swap loss. Now, in a summarized way, let me please explain once again what was this swap loss. Understand the story this way. On 15th December, the chain of contract could have come to an end because X Limited did not settle the contract. Both contracts in the chain could have cancelled, but because of FEDAI rules, the contract between X Limited and the bank in India had to remain alive. A contract that was supposed to end on that date, you have to keep it alive for next 3 working days. You have to bear some cost to do this. And how do you bear that cost? You sold dollars on 15 December. When I say you, means the bank in India had to sell dollars and it has agreed to buy those same dollars for an open contract which will settle in December. And the rate at which it has committed to buy was a higher rate, and the rate it had to sell dollars was a lower rate. This difference is considered as the swap difference, which can be a gain or loss. In this case, it is a loss because the rate at which the bank had to buy was a higher rate. Now, this swap position is mandatory for the bank in India. Why mandatory? I told you one thing, the bank could not have taken any action. So, taking no action, the bank could have made a gain or loss depending upon what is the rate prevailing when the settlement actually takes place. But in that case, if it suffers a loss because it has taken no action to safeguard itself, FEDAI rules will not allow the bank to compensate for that loss. However, if the bank in India is safeguarding its position And how can you safeguard the position? By taking a swap position. What we have sold, we are committing again to buy. And why we are doing all that? Because X Limited did not show up for settlement. That swap position, which is resulting into a loss, we just worked out rupees 91,800, it will be simply recovered from X Limited. So let me now show in the solution how to determine and how to present the calculation for that swap loss. So when in the solution you have to show the calculation of swap loss, you simply take the rate at which bank has agreed to buy, that is 86.6960, and bank sells at 86.4665. That difference is swap loss per dollar, that is 0.2295, and total swap loss will be multiplying $4 lakh into that difference of 0.2295, that works out as rupees 91,800. So you can pause the video and take note of this calculation quickly. Alright friends, once you have taken note of these calculations, let us move ahead, and now we find out the total charges payable by X Limited. Now this will be a simple working. You just sum up the cancellation charge, the interest on outlay of funds, and the swap loss that we have just computed, and the aggregate of all these X Limited will have to pay. Now one last thing asked in the question. On 17 December, X Limited wanted an extension. So basically on 17 December, if you look into, all the past contracts got cancelled. Now you just have to work out the new contracted forward rate. Now this is going to be a simple task. You identify what are the rates quoted on 17th December for this purpose, and you consider a 2-month forward contract on 17 December. 2-month forward ask rate you pick on that date, and to that you add margin so that you can work out the rate to be quoted to X Limited for the new forward contract, and that will be the last part of the solution. Let me show that calculation as well over here. So the new 2-month forward rate agreed on 17/12/2024 will be 2-month forward ask rate, that is the interbank rate, that is 86.6760, add margin of 0.12%, that will be 0.1040, and the rate which is finally agreed, it comes to rupees 86.7800, so it can be considered as rounded off to rupees 86.78. That will be the end of the solution. So you can again pause the video and take note of this whole thing. So once you have completed this entire solution, let me tell you one thing very clearly. There may be other concepts within this chapter or other chapters which may trouble you. If that is the case, you can simply put your request and I'll come up with more and more explanatory videos and taking more and more examples. And when it is exam time approaching, I would say let's keep it this kind of practice that I put up a test question, you attempt that, and then after attempting you look at the solution video. This is going to give you complete clarity on every aspect and you can keep testing yourself. Here this is not a formal test where I check your paper and award you marks. What you can do is you can take up the question in the test, you attempt that question, you make your solution, then you watch the solution video and the required explanation. Look at one thing, if you have done everything correctly, you have won the battle. So let's keep doing this, and this time in your coming exams for CA final, CMA final, let's finish it.